A 21-mile wide choke point just strangled 20% of the world's oil supply. Not a threat, not a simulation, it actually happened. In March 2026, Iranian forces declared the Strait of Hormuz closed. Ships sat idle. Insurance companies pulled out overnight. Brent crude smashed through $100 per barrel for the first time in 4 years. Then $120. Analysts at Onyx Capital are not laughing at $200. Here's what nobody is telling you. The algorithm has seen this before. The data signature of this energy shock maps almost perfectly to 3 historical moments before 3 of the worst equity collapses in modern history: 1973, 1979, 2008. And right now, in 2026, every variable is lined up in the same formation. This is not a prediction. This is a case file, and the data does not lie. Before we open the evidence folders, you need to understand one thing. Oil is not just a fuel. It is the bloodstream of the global economy. Every single product you buy, every flight you take, every item shipped to your door, its price is embedded with oil. Think of it like this. Imagine the global economy is a massive factory. Oil is the electricity that powers every machine inside. If the electricity bill triples overnight, the factory does not shut down immediately. But the costs start bleeding. Margins compress, workers get cut, output slows. Eventually, something breaks. The Strait of Hormuz is not just a shipping lane, it is the artery through which roughly 20 million barrels of oil flow every single day. That is 20% of all global seaborne oil trade moving through a corridor that is just 21 miles wide at its narrowest point. Iran sits on one side, Oman on the other, and right now, Iran's Revolutionary Guard is threatening to set ablaze any vessel that tries to cross. As of today, oil exports from Kuwait, Iraq, Saudi Arabia, and the UAE have dropped by at least 10 million barrels per day. The International Energy Agency called this the greatest global energy security challenge in history. Not this decade, history. The IEA released 400 million barrels of emergency reserves in response. Analysts quickly did the math. At normal global consumption rates, those reserves cover approximately 4 days of global demand. 4 days. Let us open the first folder. The price data. Brent crude entered March 2026 near $70 per barrel. Within 3 weeks, it had crossed $126 at its intraday peak. Both Brent and WTI surged more than 50% in a matter of weeks. The only comparable monthly velocity in oil's history was the early days of the Russia-Ukraine war, and before that, 1973. Oxford Economics ran a model. If global oil averages $140 per barrel for just 2 months, they call it the breaking point. The Eurozone collapses into contraction. Japan contracts. The US economy reaches standstill. Goldman Sachs raised its 2026 US recession probability by 5 percentage points in a single update, with Brent already above $100. Iran's IRGC is not quietly backing down. Their spokesperson announced publicly, "You will not be able to artificially lower the price of oil. Expect $200 per barrel." Saudi Arabia's largest refinery has been hit by drone strikes. Qatar's export facilities declared force majeure on all exports. This is not a market overreaction. This is a physical supply crisis. Now we open the second folder, and this is where the historical parallel becomes genuinely disturbing. In 1973, the Federal Reserve hesitated. They were cautious about tightening into an oil shock because they did not want to crush growth. They waited. Inflation became embedded. When they finally moved, they moved hard. The equity market lost more than 40%. In 1979, the same trap closed again. Oil spiked after the Iranian Revolution. Inflation re-accelerated. The Fed under Paul Volcker eventually slammed rates to 20%. Another recession, another bear market. In 2026, the Fed walked into the meeting with US headline PCE inflation still running at 2.8%, core PCE at roughly 3%. Chair Jerome Powell went on record stating that energy costs linked to the Iran conflict were now a significant driver. The March FOMC held rates unchanged at 3.5 to 3.75%. The market had been pricing in multiple rate cuts this year. Those cuts are now gone. The 10-year Treasury yield jumped more than 30 basis points in March alone. The bond market is already pricing in a world where the Fed cannot move. This is the monetary policy trap. Oil forces inflation higher. Inflation forces the Fed to stay restrictive. Restrictive policy slows the economy. A slowing economy collides with high oil prices. The algorithm has a name for that combination: stagflation, the single most destructive macro environment for equity markets. Now, we open the third folder, valuations. The S&P 500 entered 2026 near all-time highs. Forward, price-to-earnings multiples were sitting in the high 20s, well above every historical average. The market had priced in double-digit earnings growth for the year, around 11%, based on one core assumption: a smooth disinflationary glide path that allowed the Fed to cut rates. That assumption is now broken. The Nasdaq 100 was already down roughly 5% year to date before this week's data. Long-duration growth stocks, the AI darlings, the mega-cap tech names that dominate index weights, are the most vulnerable assets in a rising real yield environment. Their valuations are built on cash flows expected years or decades in the future. When the discount rate rises, those valuations implode mathematically, not metaphorically, mathematically. And this is the part the financial media is glossing over. Every post-war US recession has been preceded by a sustained rise in oil prices. Every single one, not some, all of them. The Federal Reserve's own research confirms this. The question has never been whether a sustained oil shock causes economic damage. The question is always the degree. The case file we keep returning to is 1973, not because it is the most severe oil shock, but because the setup was nearly identical to today. In October 1973, OPEC declared an oil embargo. Prices quadrupled in months. Inflation was already elevated from prior spending. The market was richly valued after a prolonged bull run. The Fed was behind the curve. Sound familiar? The S&P 500 fell more than 40% over the following 21 months. It was not the largest crash in dollar terms, but it was arguably the most structurally damaging because it was slow, grinding, and accompanied by an economic environment where every policy tool had a cost. Cut rates, inflation spikes more, raise rates, growth collapses faster. The 2026 setup adds one additional layer that 1973 did not have. Global debt, total public and private debt as a share of global GDP is dramatically higher than in any prior oil shock era. Higher nominal rates in a high debt world do not just slow growth. They can trigger cascading credit events. So what does this mean for the portfolio? What does the data tell us to watch? Our analysis is tracking 3 specific signals right now, not gut feelings, data signals. First, break-even inflation rates. If 5-year inflation expectations in the bond market break materially higher from current levels, the Fed loses the luxury of patience. Rate hikes become probable. That is a trigger for the next leg lower in growth equities. Second, credit spreads. High-yield credit was already under quiet stress in early 2026. If spreads widen significantly from current levels, leveraged borrowers start to crack. That is a trigger for a liquidity event, the kind that turns a correction into a crash. Third, Nasdaq relative performance. When the Nasdaq stops leading on rally days and starts leading on down days, institutional rotation is already happening. That is a signal that the market leaders are being quietly sold. In our own portfolio, we are watching all 3 of these daily. We have been reducing exposure to the most valuation-stretched growth names. We have been rotating toward energy producers and quality cash-generating businesses with pricing power. We are holding a larger than normal cash position because when dislocations happen, cash is not a losing position. Cash is ammunition. The IMF's rule of thumb: a sustained 10% rise in oil prices cuts global GDP by roughly 0.15 percentage points and adds 0.4 percentage points to global inflation. This shock is not 10%. This is over 50% in 3 weeks. The arithmetic is not subtle. Wells Fargo, Oxford Economics, Man Group, and Goldman Sachs all now agree. A sustained period of oil at $120 to $140 per barrel is likely enough to tip major economies into contraction. The only debate is timing. The 2007 playbook is worth reviewing here. WTI crude climbed from roughly $28 in 2003 to $134 by mid-2008. Markets were too busy celebrating the credit boom to notice the oil signal. The global financial crisis was a credit crisis, but the oil shock was a suppressor the media removed from that bullet before it hit. It constrained what the Fed could do. It hit consumer real incomes before the housing market did. It set the stage. Right now, the stage is being set again. Here is the verdict from the case file. The data does not say a crash is certain. The data says the conditions for a crash are more aligned today than at any point since 2008. Oil above $120 with a Fed that cannot cut. A market priced for perfection, a consumer that is already stretched, and a global debt structure that has never been more sensitive to rates. That combination has not ended well. Not once. In recorded market history. The detective does not predict the future, the detective reads the evidence. The evidence says, be alert, be positioned, and do not be surprised. One question for the comments. The 1973 crash lasted 21 months before the market found its floor. If the same playbook runs in 2026, where do you think the bottom lands? Is the S&P 500 revisiting 4,000? Or do we see something worse? Put your answer below. The data on previous comments suggests you have strong views on this. We read every single one, and if this kind of deep forensic market analysis is useful to you, we have launched our exclusive newsletter for daily market analysis and deep decoding. Gain your free access today to join our inner circle. Link in description. Because in markets, the people who see the pattern first are the ones who survive it. Data does not lie.